What if I told you the biggest investment mistakes people make are not really mistakes, but traps set long before you ever enter the market? What if the biggest market crashes in history were never random events, but predictable outcomes of a hidden financial machine designed to profit most when you suffer the most? What if every crisis you lived through, every recession you survived, and every investment mistake you made were all shaped by forces you were never supposed to see? And what if the truth is that the people who rise after every collapse do so because they know how the system really works? Today, we are breaking open the core of that system. Not the stock market you check on your phone. Not the bank account you see every day. I am talking about the invisible network running behind all of it. A structure so deeply wired into modern finance that every crisis, every boom, every panic, and every recovery follows its script. This is the shadow banking liquidity web, a maze of derivatives, hidden leverage, and off-balance sheet credit paths that create the illusion of stability while quietly transferring wealth upward in every collapse. If you have ever wondered why your savings lose value, why prices rise faster than your paycheck, why debts get heavier even when you work harder, you are about to see the reason. This is not a story of bad luck or poor choices. It is the leftover damage of a system engineered decades ago that still decides who wins and who loses. Before we dive in, let me know where you are watching from. The comments here are more than a chat box. They are a community of people searching for unfiltered truth. And if you are tired of the surface level explanations and want the deeper answers buried beneath the headlines, hit subscribe. Because what you will hear today is the part of financial history no institution wants explained clearly. Let's start with the pattern that links every major crisis across the last century. The official stories never add up. You have heard them before. A housing bubble, a tech bubble, an inflation shock, a surprise recession. But those headlines are only symptoms. The real cause begins long before the panic, buried in the places where leverage grows quietly, where risk is pushed into corners no regulator can easily see, and where the rules of the game are rewritten by those who never lose money. In the early banking panics, the narrative was simple. Too many people rushed to withdraw money, but hidden behind the panic was a deeper problem. Banks had created far more credit than they could ever support. Leverage outpaced liquidity. When confidence cracked, the system collapsed. Sound familiar? Move into the Great Depression. The textbooks blame speculation and overproduction. They never mention the network of new financial instruments, credit layers, and unmonitored risk transfers that grew faster than any agency could track. It was the shadow version of finance before the phrase existed. Sound familiar? In the 1970s, inflation and currency instability shook the global economy. But once again, the real issue was that banks had found ways to create offshore dollar credit through our markets, a form of shadow money that exploded without oversight. It kept expanding no matter what central banks did. Sound familiar? And then came 2008, the moment the world finally saw what happens when hidden leverage meets falling confidence. Everyone remembers the collapse of subprime mortgages, the toxic securities, the desperate bailouts. But those were only the surface cracks. Underneath was something far bigger. A web of derivative contracts, repos, swaps, and back-channel credit. Agreements so dense and systemically important that regulators had no idea how large it had grown. Here's the shocking part. The institutions that caused the crisis did not just survive. They got bigger. They made record profits in a decade that followed. They strengthened their position. Meanwhile, ordinary people lost homes, jobs, savings, and stability. This is the repeating pattern. Crises do not destroy the elite. Crises consolidate their power, but the real turning point, the moment that allowed this entire shadow system to take over, happened earlier. Not in 2008, but in the late 1990s, when one quiet decision changed everything. Before this moment, banks had limits. They had to report risk. They had to keep leverage in check. They had to hold reserves for dangerous positions. But once regulators allowed derivatives to escape oversight, everything changed. Risk could now be moved off the balance sheet, hidden, repackaged, sold, insured, exploded into chains of contracts that no one could fully map. With one rule change, the door opened. And through that door poured trillions of dollars in synthetic credit. This new world created the perfect illusion. On paper, banks looked safer, cleaner, less risky. In reality, the danger was simply moved into the shadows where it multiplied without control. This is the part most people never hear. The modern financial system is not built on money. It is built on promises, contracts, and obligations stacked on top of each other like unstable towers. If even one pillar cracks, the shock travels instantly across the entire web. So who opened the door? Who signed off on the loophole that unleashed the derivative wildfire? You will not believe the name, and the receipt is wilder than you think. To understand how to navigate market crises and avoid the most painful investment mistakes, you need to understand the shadow structure clearly. The shadow banking liquidity web is not a bank. It is a network of institutions that operate outside traditional rules. Investment banks, hedge funds, money market funds, insurance giants, private credit pools, special purpose vehicles. These entities collectively create credit, liquidity, and leverage without being classified as banks. Derivatives are the blood of this hidden system. Contracts on interest rates, currencies, bonds, loans, equities, and anything else that can be turned into a mathematical model. They create the illusion of eliminating risk. In reality, they spread it thinly across the entire global system. This is how a simple $50 billion pile of bad mortgages turned into over $500 billion of toxic assets before 2008. This is how a single hedge fund in 1998 needed a massive coordinated rescue because its derivative exposure was large enough to threaten the global system. This is how, in March 2020, liquidity vanished in minutes when institutions refused to roll over credit. But hidden beneath the derivatives lies something even more dangerous: off-balance sheet leverage. Banks create independent structures called special purpose vehicles to hold risky assets. These vehicles borrow money, issue securities, and take on leverage far beyond what a regulated bank could legally touch. By 2007, some banks had more exposure hidden off the books than on them. Citigroup alone controlled more than $1.1 trillion in off-balance sheet entities, and regulators had no visibility. This is how the system grows without anyone noticing. But how does this impact you? Retail investors lose money in crises because they do not see what the shadow system is doing. Institutions move first. They pull liquidity first. They de-risk first. They hedge before volatility arrives. They see signs retail investors never watch. To protect yourself, you need a survival framework. And these are the essential strategies. First, liquidity is everything. Crises always punish liquid assets first. If you cannot convert something into cash quickly, it becomes dead weight during a panic. This is why you always keep a healthy cash buffer. Cash is not wasted. Cash is protection. Second, never use leverage unless you control the exit. Retail leverage through margin is dangerous because the broker decides when you get liquidated. Not you. Institutions use guaranteed lines of credit. You do not. So never use leverage that can force you out of a position at the worst possible time. Third, avoid chasing returns during late cycle credit expansions. When markets rise too quickly, it is usually because shadow credit is flooding the system. That always ends with a correction. When debt grows faster than income, brace yourself. Reduce exposure. Fourth, diversify based on liquidity behavior, not just category. Stocks, real estate, bonds, crypto, and alternative assets often move together under stress. You need layers of liquidity. Some cash, some short-term bonds, some equities. Only then consider long-term plays. Fifth, learn the signals institutions watch: widening derivative spreads, repo rate spikes, declining demand in the commercial paper market, currency volatility, sudden drops in long bond yields. These are early warnings. When these indicators flash, something bigger is brewing. And that brings us to the final warning. The next crisis will not be slow. It will not give you months to react. It will be fast, digital, and global. Algorithms will accelerate panic. Automated trading will amplify every shock. Liquidity will disappear in seconds. And institutions will be ready long before retail investors understand what is happening. But with the right knowledge, you can protect yourself. You can avoid the mistakes that wipe out unprepared investors. You can build a strategy that survives volatility and grows through uncertainty. This is the truth we live in. The system is built on borrowed time. Every boom depends on hidden leverage. Every collapse transfers wealth upward. The only defense is understanding how the machine works and positioning yourself ahead of the storm. So let me leave you with one question. Are we wiser now, or are we walking the same path in better suits? If you want to keep learning how to navigate this system, share this video, drop your thoughts below, and hit subscribe so you never face the next crisis blind.